All are well. Welcome back to Secret Indian Trader channel. So let's go to today's topic, and it's regarding the price action chart patterns. So if you are trading on any stocks, it is really necessary to watch the volatility of the market and the higher highs and lower lows. So what is the highs of the week and the month? And if it's like a short-term investment, you have to check for the days. So it's really necessary to analyze a chart fundamentally and technically as well. So let's get into the price action chart patterns, which is really required to analyze a chart. So the first one is head and shoulders upward. I would say head and shoulders, which as the name says, there will be two shoulders which will be a bit lesser heap than the head. So the first short heap is considered as left shoulder, and the highest triangle will be considered as head, and the lowest triangle, once again on the other side, will be considered as right shoulder. So what it represents it is we have to mark a neckline, which is like a point or line in which all the triangles meet together. So we have to figure out the neckline of a stock. Um, so if you see here on the right side, when the neckline is broken, there is a breakout point. This is the breakout point. So you could consider taking your trade at any of this place, but please make sure that the price does not reverse. So if the price reverses, you have to make sure that you come out using your stop loss. If the neckline is being neckline is kind of followed by the chart, then you will have a probability of high profit, because the opposite side of the right shoulder will be a huge breakout once again. So if you can see on the real-time example, so we have a first shoulder and then a higher triangle which is considered as head, and once again the right shoulder, like left shoulder and right shoulder. So if you can see, you can take an entry over here, and your stop loss will be higher than the right triangle, which is right shoulder. So this is the concept of head and shoulder upward. So similarly, we have an inverse head and shoulders pattern, which is very similar on the opposite side. So this is like an uptrend once again. If you see on how the price falls initially, so the price falls and it crosses the neckline once again. That is a head, and then the right shoulder. So once it crosses the right shoulder, there is a breakout over here. This is the breakout point once again. So the neckline is being retested once again, and the price will increase. So we have to make sure that the price does not reverse over here once again. So similarly, if you see in the real-time chart, it will be not very clear like this. However, we have an assumption. You can convert it to a line chart, and you can double check with different time frames. So if you see in this real chart, we can make an assumption that this is the first heap over here, and this is the second heap, and the third heap. So there is a breakout over here. So in this case, we get a confirmation that the price is going to go high. So we can take a trade over here, and if you can see, the price will increase once again. So this concept is called head and shoulders pattern. So let's go to the next one, which is double top. So double top is nothing but there is a high resistance band at the top, which is like if a share is been overbought for multiple days, then the share will be on the higher band of level, which is above 80 or above 85 to 90 RSI, I would say, but it is not limited to that. It can be even more higher than that or even less. So once the stock price touches the resistance point, the stock gets reversed. If you can see, um, you have the resistance in this particular range, and then the stock get reversed once again. So we have to make sure that you can take a trade over here, and you can sort a stock. So similarly, like if you see the actual price on the regular stock, so there is a first heap. So if you can see, this is the band, this is the region where there is a kind of support. So so this is the support over here. So this particular support has been broken over here, and it touched the resistance place. So once again, there was a resistance in here in this region, and then the price fell down due to some selling. People sold stocks, so the price range fell down. And once again, from here, if you can see, the price range was being hiked for the same range. However, there might be some kind of you can see some bullish views. However, you have to take uh, upward, I would say, um, you can buy stocks only if you get a confirmation that this particular resistance band is broken with good wick. Okay, or else you should not take a trade over here for buying. um, Instead, you can sell a stock over here. If like waiting is like patience is very key role over here. So you need to have more patience, that you have to wait for at least like 3 or 4 weeks, and make sure that the line is being broken, or is the stock is being consolidating, or what is the action going on over there. So if you see, this particular wick says that there is no bullish over here. So in this case, you can of course, like, um, sort this stock, sell this stock. So if you sell here at the edge, you can get a you can get make a good profit, and you can place your stop loss above this resistance place. So this is called double bottom, sorry, double top, and the inverse one is called double bottom. So double bottom, you can see two bottoms. It's like inverse of the previous concept. It's two bottom points, mm, two support, like there is a support and a resistance band once again. So the stock price just touches the first support line, and then it goes to the neckline and the second bottom, which is second support line, and then there is a breakout. So this is called double bottom. You can take, if there is a proper breakout over here, you can take a buy option, you can buy stocks over here, and you can sell it with some profit. So similarly, rounding bottom, which is nothing but it is very similar to the previous one. So if there is a proper consolidation in multiple triangles, like if you see, it can be easily measured in a stock analysis, like once you see a downtrend, you will have multiple downtrends going on, but the volume of shares which has been bought will be high at this point. So you have to compare this particular chart with the volume of shares which has been bought at the time of trading time trading. So when you have equal fund, however, if the volume of stock is being traded high at the second point, you can certainly get into the trade, but please make sure that that you're getting a good uptrend over there. So you can mark a neckline once again at the entry of this circle. So once the neckline has been broken, you can take a trade over here. But please make sure there is no trend reversal over here, because anytime the market can surprise you. And the next is the advanced concept of rounding bottom, cup and handle, I would say. So in this particular concept, so we have a rounded bottom, and then once again we have a small curve which is considered as handle, and then it breakouts on the opposite side. So neckline is nothing but the resistance level of the stock during that range. So inverse cup and handle, similar situation. You have a big curve over here, and then you have a small curve. So once the support line has been broken, then there will be a retest of this stock in this support line, and then it just breaks out and goes down. So similarly on the opposite side. So next is wedges. Wedges is nothing but it's like as the diagram suggests, the stock moves in a triangle wise, in the downward triangle wise. So if you can see, first the stock is in downward, and then it rises to upward, and once again downward, and then so it's like there is a consolidating taking place on the lower level. So we can able to easily find this type of trading pattern. So you have to draw support and resistance level. So once you find a breakout over here from this particular wedge, you will have a good volatility or movement of the price range. So once it breaks over here, you will at least find you would be at least able to get up to this level. So it's very good to trade in wedges. This is a very nice one among the very effective pattern as well. And the next one is pennant um, or flags. So flags are nothing but we have multiple consolidation at many places. So once we have a consolidation and there is a breakout, and then after a bullish movement, and then once again the the price gets consolidated, and then once again it's a breakout. So it moves in the form of flag. That's why it's called flag pattern. And once again in the downward trend is the same thing. So if you can see, the movement of the price is once again bearish over here. So pennants is nothing but it's similar to wedges. So first there is a breakout, and then a wedge pattern formed over here, and similarly in this bullish uptrend, and then similarly in the downtrend uh, we have this wedge pattern formed at the bottom of chart. Triangle pattern, we have three types of triangle pattern. It's very similar to wedge. However, it's like ascending triangle is nothing but upward wedge, and descending triangle is downward wedge. And if it's like symmetric triangle, it means that there is a probability that it might go up or down. So anything is based on the day's fundamental. So guys, that's all I have. These are the very important chart patterns, which is super important, and it's really useful while researching on stock on the charts. So once again, thank you for watching, and if you have any comments, please let me know in the comment section. Please subscribe to my channel. Thank you.